Let's start our topic of today. Today, our agenda is that we're going to cover about flexible budget variance and management control one, as well as flexible budgets, variance, and management control two. It means we are covering two chapters, chapter number 7 and chapter number 8 from your book. So this chapter, as the name is reflecting, that we are talking here in this chapter about flexible budget. There is a one static budget every organization preparing before the start of financial year or before the start of any period they define. Uh, and that budget is based on some anticipation of the volume, what they want to how much they want to do their business, like the output or provide services to the number of customers. So that's what we call it as a static or a master budget. Flexible budget is later on we made based on the actual quantity, how much we produced in actual terms, and the cost or the prices or per unit uh, 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 costs are used or revenues are used, price and costs are used based on the static budget. And that's what we call it as a flexible budget. So we are flexible in terms of how much we are producing. So this whole chapter and the next chapter is covering this idea that how we can find out the variances. Now, variances are very important from the management perspective because the managers not just look at what they are getting day-to-day operation, but every day or every week or every month they compare it from their targets, because budget is a plan for achieving certain things, and they compare it from their targets in respect of every item in their budget, like how much they are achieving, how much they are far from that, and if there is a way that they can correct it during the period, so that at the end of the period they are not deviating or they are not far off from the budget. So this is the way that variance helps the managers in retail, in every business. In the first thing the managers normally in the morning do, that they compare the yesterday figures, because at the end of the day the figures are or the data are available to compare with the day before yesterday. And then they see that, okay, what are the deviations, and that's a very effective to see the variances between the 2 days in effective way, that they could control if there is any abnormal deviations from any figure, like cash is different than the last 2 days, so they can figure it out why there is a difference. There is a possibility that there is a genuine reason that there is a difference, but the manager should know that why there is a difference, or the receivables or payables or whatever they are in their financial statements or in their books they or the data they can access. So they are looking for a variances, and if there is any variance, so they figure it out why there is a variance. So that's the way that we will start this chapter. What are the learning objectives of this particular chapter number 7? We have to distinguish, as I mentioned, that we are focusing on these two chapters about the flexible budget. So we will distinguish it between what is the difference between a static budget and a flexible budget. So that's the first objective that we want to achieve, that you must understand, and what's the difference between a static budget and a flexible budget. Then we develop the second level analysis of, or we can say that finding out the variances at the second level. So we will discuss that there are certain levels, like a zero level, level 1, level 2, level 3 of analysis. So when we further go into deep details, then we increase the level of analysis. So that's the way that it works. So in this chapter, we cover the second level, mostly the second level analysis, and we also touching the very on a very superficial way the level 3 as well, but mostly focus is level 0, 1, 2. So that's the way. Understand variance analysis in activity based cost accounting. So last class or last chapter, what we covered is an activity-based management or activity-based costing. So activity-based costing, you remember we break it down on the hierarchical costing method. Like there are certain things which we are doing on the product level, unit level. There are certain things we are doing on a batch level, and then organizational sustainability or the product sustainability. So these are the things that we have to divide the all the cost into that, and then analyze the variances in order to get a better idea. So that and at the end, we will see that how the managers can benefit with these types of variances. And in the beginning, as I mentioned, that it is a very useful tool, and every organization, the managers are using it to identify is there any problem that we can rectify so that variances can be reduced. So let's start the now. We see here that what is a variance. That's sort of basic concepts we're going to talk about. Management by expectations, that's another uh, word that we have to understand, or the definition of that. Variance analysis, how we define this. And there are two words we commonly use in the variance analysis is favorable variance and unfavorable variance. So what is variance? The difference between actual, like the actual outcome of your operation or realized one, and the budgeted. Budgeted means planned or pro forma based, or the results which you predicted or anticipated or projected that you want to achieve that. So it's a planning, it's a difference between the actual and the planned one. So that's what we call it as a variance. Management by expectation means that the practice of focusing attention on areas not appearing as expected. So budget is an expectation or expected outcome. So if we are adopting a management style which we call as management by expectation. There is a different styles of management, like management by objective, management by expectation. So when in an organization, if we are emphasizing on the budget and all the year focusing that every department or every unit of the organization should focus on their particular budget and try to achieve those budget. So that style of management, we call it as a management by expectation. So if that is the style, then we have to be always focusing on the areas operating as and why they are operating not as per expectations. So that's variance analysis. This is whole analysis that going to help us to figure it out, or discovering why actual results fail to meet expectations. So why we are lagging behind the targets, why we are lagging behind or not able to achieve our the budgeted targets, budgeted figures. So this is what we call it as a variance analysis. Now, as I mentioned that in this variance analysis, very commonly used favorable, unfavorable. Now, favorable and unfavorable is that results in operating income that exceeds the budgeted amount. So now we have to be careful. Now, careful in what respect? Like if we are looking at the revenue side, and revenue side actual results are better than the projected or expected ones, then we call it as a favorable. But on the cost side, if the expected results are higher than is less than, or the targets are less, and we are spending more money, or the cost is higher, then we call it as unfavorable, right? So it we have to be careful. Like actuals are higher in revenue, it's favorable. If actuals are higher in cost, it is unfavorable. So unfavorable results in operating income that is less than the expected budget. So that's the scenario for uh, expectations and favorable or unfavorable. So let's start. As I mentioned that these analyses are of different levels. So the first level, or we call it as a zero level, excuse me. uh, so Further analysis decompose, break down the level zero analysis into progressively smaller and smaller components. So what is the objective of a zero level analysis is how much were we off from the target, from the budgeted figures, how much the values we are actually producing is far from the budget. But the level one, two, three examines the level zero variance, what we identified. That's a basic difference that how much we are anticipating our net income and what we get. That difference is called as a zero level analysis. Just look at the bottom line of a income statement and find out the difference between the budgeted ones and the actual ones. That is called as a zero level analysis. Now, level one and two and three is to further break it down and the analysis of this outcome of zero level analysis. So progressively more detailed level of analysis, and the answer, what we are trying to do in level one, two, three is where and why were we off. So the zero level is how much were we off, and the level one, two, three is where and why were we off. So this is the difference between zero and, because if we further dig down the analysis in order to figure it out, where is the real problem? Because the net positions, net income is not telling whether the revenues are short or the costs are high. So what we want to dig it further in order to get where the problem is and why the problem is. That's the role of managerial accounting, that we have to provide the manager or the management of the organization and the data so that they know where the problem is and how they can resolve it. Now, let's start with the difference between static and flexible budget. So static or master budget based on one level of output. So that's anticipated or projected or forecasted level of output, one level of output. It is not altered after it issued, even circumstances changes. So it's a master plan. We prepared for the organizations before the start of a year, and that master plan is not going to change in whatever the circumstances is, because financial world or the this market situations are changing. But when we prepare a master plan, that's our master plan. Whatever is happening, we have to see how much we are deviating, how much we are off from this master plan, and what are the reasons. But we are not changing the master plan according to the situation. So that's why we call it as a static. Once it is prepared, when it is finalized, when it is done, it's now fixed. And now whatever is happening, we have to see how far we are, how ahead of we are, or why we are. So that's a thing that why is we call it as a static. Now the static budget variance, which we call it as a zero level variance, is the budget which is a static or a master plan budget and the actual day and the actual outcome. So budgets are normally prepared in the beginning of the year. Actual results are the actual results are in a hand after the period. So we will do this type of analysis after the period with the actual values and with the budgeted or with the planned one. So the difference between the actual result and so the difference between the actual result and the uh, corresponding static budget amount. This is the highest level of analysis, a macro view of operating results with no details. So that's just only a difference of a bottom line, and that's a very macro level. We cannot know, we can't get the idea that why it is different, what is the main cause of that difference. So that's a However, the flexible budget we prepared after getting the actual results, and the budget which is adjusted for change in the actual level of output or actual revenue and cost drivers. So this is the budget we prepared based on the some budget data, based on some actual data, a budget which is uh, according to the cost and the prices of the budget, and the output level is of the actual. And we see that if we operate at the budget at the actual level with the budgeted figures, then what is the outcome? And then we compare it. This is what we call it as a flexible budget. So hypothetical budget that would have been prepared at the beginning of a budget period if actual output was known. So if actual output was known, then we can prepare it flexible budget. Otherwise, so normally it is allow for more meaningful comparison between adjusted budget and actual budget, actual results. So that gives us a more accurate idea that if because of certain market condition changes, if our output is low or high, and then we multiply it with the budgeted values of price or a cost, then what is the outcome? And that's more practical, more meaningful as compared to the static budget analysis with the actual outcome. Now, if you look at this table, and this very interesting table, to see that what we are talking about, the level one and level zero and level one analysis. So we can see here very clearly that the operating income actual result is 25,000. And the static budget, which we prepared, is anticipating that we should have a net income of 262,000, right? So that's our expectations in a static budget, and this is our actual result. So it's a huge difference. And this difference is what we call it as a zero level analysis. So if you look at this zero level analysis, and so we see here the difference between this value and this value is $237,000 unfavorable. Why we are saying unfavorable? Because it's less than the projected ones or less than the budgeted ones. Now we further break it down, and this is what we call it as a level one variance analysis. Now it's again, we are not breaking it down in very detail, but very clearly that how much units we sold. So this business is selling jackets. So in actual, we sold 10,000. What we projected or what we planned in our master static budget is 12,000. So this is an unfavorable 2,000 numbers of unit we sold less. Total revenue when we sell the jackets of 10,000, so we create a revenue of 1.850 million. What we projected is 2.1 million. So that's a again unfavorable, that the revenue side is unfavorable with the 310,000. Now, if we look at the total variable cost, so variable cost 1,120,000, 1,120,000, or we can say 1.120 million, as compared to what we are expecting that we can incur. The variable cost is 1.188 million. So 1.188 million is comparatively higher than and the 1.120 million, and that's why we call it as a. So here in this case, we are less doing less than the static. So you can see what I mentioned before, that if the revenue is less than the budget, we call it as unfavorable. But if the cost is less than the budget, we call it as favorable. So that's why you see here that it is favorable. The variable cost variance is favorable. And similarly, if we go further, that the contribution margins and fixed costs, so we see that contribution margin is unfavorable, because contribution margin means that we subtract the variable cost from the revenue, and as the revenue is unfavorable, so we subtract the favorable variable cost, and by this way we get it contribution margin. And then we have a favorable fixed cost as well, and we see that how much we projected 710,000, but actually we did 7,500. So by this way, we have a favorable of 5,000 fixed cost. And altogether, you see again, we come to the same zero level analysis. Now, this very first level analysis after zero level. So zero level, we understand that there is a unfavorable amount of 237,000. Why? Because we are making less profit as compared to what we planned in our static budget. We further analyze this with the level one analysis, and we divide this into mainly the revenue. Definitely revenue is based on number of units we sold, and then cost, variable cost, and fixed cost. And by this analysis, we come to know that the main issue for not achieving or lagging behind, far lagging behind the target is the short of revenue. And why the revenue is short? Because we sold 2,000 less units of jackets or whatever we are producing. So you see, in the beginning, we don't know what is the problem at the zero level. We don't know. We just know that uh, there is a problem that we are not achieving our budgeted figures, and it's very far from the budgeted figure. But when we further analyze, we identify, okay, yes, the reason is that we are short of uh, revenue, and revenue is the major cause of this decrease in our net income as compared to our budgeted ones. And why the revenue is less? Because we sold less. And we see that the cost is favorable, but it is not so praiseworthy, or it's very not so important to note that the cost is favorable. The reason behind is that if we produce less, like 10,000, and we sold less, so definitely the variable cost is going to be less. It makes sense because the cost is material, labor, manufacturing overhead. So if that's a short, so it means that, so we see here that this one more step analysis help us to give a again very not in very in detail idea that whether it's a inefficiency or whether it's a recession in the market, or we are able to sell less because of the decrease in the prices, or there is a substitute available in the market, so for that reason the demand go down. But we are just focusing only on that to identify the reason. uh, So, if I summarize this whole idea of this two-step analysis, one is which we call it as a level zero analysis, and we see here that zero level analysis is giving us a figure of providing us this information that we are short of 237,000. But when we further analyze into two categories, that how much the revenue is going to be affected, and we see here that the revenue is reduced or short of 310,000. On the other side, we have a cost which is favorable, like 73, 68 is favorable in variable cost, and 5,000 is favorable in fixed cost, and by this way there is altogether is 73,000 favorable. So far, is it clear that we can do level zero and level one analysis with the actual figures and with the uh, static budget figures? Now, for a level 2 and 3 analysis, we need to prepare a flexible budget. And as we mentioned, that flexible budget is a budget which is based on, it's an hypothetical budget based on actual quantities, and the price and the rate of costs are applied from the budget or the static budget. Shift budget revenues and cost up and down based on actual operating results. So that's a shift budgeted revenue and cost up and down, because if we are on actual operating results, on actual operating results or activities means that if we take very simple example of this previous case. Now, if we prepare a budget on the basis of 10,000 units sold, the revenue, the price should be of according to the static budget multiply by the 10,000 and all the costs also on the basis of 10,000 units. So then it is a flexible budget. So it represents a blending of actual activities and budgeted dollar amounts. So blending actual activity, as I mentioned, operations level and the budgeted dollar amounts, the price and the costs will allow for preparing or preparation of a level 2 and level 3 variances. And this level of variance analysis, level 2 and 3, going to give us the answer for why were we off. So we first figure it out how much we are off, then we figure it out where we are off, and now we are trying to figure it why were we off. So this a flexible budget is developed using alternative level of output. So for just general understanding, what we did, we in this particular example, we prepare three different flexible budgets for just to give you an idea that how the flexible budgets are prepared. So these three lines, these three columns, or these three columns are flexible budget. One column is flexible budget at the activity level of 10,000 units. The second flexible budget is activity level of 12,000 units. And the third flexible budget is at the activity level of 16,000 units. Uh, so let's start. We see here that the revenue is calculated in our budget figure based on 180. So how we get this 180 per unit? You see here, we anticipate that we are able to sell 12,000 units and with the price of 2.10 million. So if you divide this, you can get it this value. So we just simply multiply this 180 with 10,000, so 1.8 million, 180 with 12,000, so 2.1. So this is 16 multiplied by 180, so we get it this 2.8 million, and actual we know that it is 1.65. So it's a little bit. I want to make it bigger, but I don't know how. Yeah, that's big. That's good. Great. So we see here that these are different levels of output, 10, 12, and 16,000. And we get these type of these revenues based on each level of output. And this is our actual one. But you see that this 180 we are not getting by dividing 1.85 with the 10,000. We are getting this 180 by the static budget. 210 divided by, if I take you back, uh, uh, and this 2.160 million divided by 12, that is going to give us a 180. Same is the case with the information. We can get it that how much direct material we are using. This is a static budget figure per unit for this is budgeted amount per unit for direct material, manufacturing labor, marketing labor, variable manufacturing overhead, variable marketing overhead, total variable cost, and that's a contribution margin. So we see here at each level we apply the level on these per unit, and we get these values for each level of output. And then we have a fixed cost. Fixed costs are not presented here. The reason is that they are fixed, so it's not going to change with the. So we see here that the amounts are same for all the three levels, and marketing overhead, manufacturing overhead, and total fixed cost is same 710 for all the three levels. And total cost is this, and by this way we get it these net operating income at three different levels, and this is our actual ones. So flexible budget, difference between the actual realized result and the flexible budget amount of revenue. So flexible budget variance is going to give us the variance between actual result and the flexible budget amount. Now, when we do this, so there are two types of figures. What we're getting is here is when we compare the flexible budget with the actual figure, we get it flexible budget variance. This is what we call it as a flexible budget variance that is between actual results and the flexible budget amount. There is a volume variance, sales volume variance that is again a risk analysis based on the flexible budget amount and the static budget amount. So these are both budgets. Now, what is the point to understand here is that in this case, you can see that the activity level is same. So there is no need to figure it out with the volume type of things. This is a flexible budget variance that how much we are varying from um, uh, the uh, the flexible budget and the actual budget because of uh, the revenue and cost drivers. Volume variance is between flexible and static budget because now the amounts, the dollar amounts for price and cost per unit is same. The only difference is a activity level, and that's going to give us a sales volume variance. So what we did here in this graph or in this table, if you look at very carefully, what we did is that we write the actual results first and static budget results in the last column. So we take it's a 5 column sheet in which the first column is an actual result and the last column is a static budget. And in the middle, we write it flexible budget. Right. So this is way that we left 2 columns, one on the right side of the flexible budget, one on the left side of the flexible budget. And after that, we have a actual result and the static budget. Now, when we compare the actual with the flexible budget, that what we call it as a flexible variance, a flexible budget variance analysis, right? So what we do 1 minus 3 because the third column. So we get this like the activity level is unit sold is same, no difference. And this is by the way, this is a second level variance analysis in which we introduce the flexible budget. We see here the revenue, which is favorable, variable cost unfavorable, contribution margin unfavorable, fixed cost favorable, and altogether we see that there is a 75,000 unfavorable between flexible budget and the actual. Now, when we compare this flexible budget with the actual or a static budget, not actual, static budget, we see again there is a unfavorable, and this is what we call it sales volume variance. There is an unfavorable unit of sold, unfavorable revenue generation, favorable variable cost, and unfavorable contribution margin. There is no deviation in fixed cost. So we see here that the unfavorable of 162,000 in the net income. So what we did, we figured it out at a zero level analysis that the variance of net income is of 237,000. Now we break it down this 237,000 into two parts. One part we call it as a total flexible budget variance, which is 75,000, and 162,000, which is again unfavorable. So both are unfavorable. So that's why we're going to add up total sales volume variance. So we can say that that the 162,000 is because of that we are able to sell less. And that is the main reason for our far from our static budget. And this when we add up this two, so we get it, this is the total static budget variance. Or so you understand the level 2. So level 0, just a difference between the net income of static budget and the actual one. Level 1 is that we again break it down this into revenue in variable cost and fixed cost, and see that what is the difference and where is which one is favorable, unfavorable, based on again with the uh, uh, actual and the static budget. Level two analysis introduce a flexible budget, and in the flexible budget, when we compare, we see that there is a flexible budget variance between the flexible budget and the actual, and there is a sales volume variance between the flexible budget and the static budget. Now, level three analysis is now we are further deep it down towards the price or a rate variance, that which price is deviating, the price of the goods we are selling or the goods or services we are selling, or the cost of per unit cost of the input we are using. So that's all. So the difference between actual and budgeted price multiplied by the actual input. So price or rate or input variance, that's what we're going to call do in a level three price rate variance analysis. So how do we get the price variance? Actual price of input minus budgeted price of input. So that's the difference between the price of inputs or the cost of input into the actual quantity of input. So see that that is a price variance. Now we are further break it down into how much we are losing because there is a possibility that the input prices increase, which is beyond the control of management. There is a possibility that the prices of the product we are selling go down. That is again beyond the control of the management. But the thing which is in the control of management is a efficiency or a usage variance, and we calculate the efficiency variance at level three analysis. So how do we figure out efficiency variance? So efficiency variance is actual quantity used of input minus the budgeted quantity of input allowed for actual output, allowed for actual output. Budgeted quantity of input allowed for actual output into the budgeted price of input. So that gonna give us that we are far from our target. The reason may be inefficiency, and that's gonna figure it out the inefficiency. So we see here that in this diagram, in this tree diagram, that this is our zero level analysis. This is our level two analysis and level one analysis. So we further break it down. Uh, this one is a level one analysis, and now we are doing level, and this one is our level two analysis. Now we are focusing on level three, in which what we are doing is that we are figure out that direct materials variance. If there is a direct material variance, how much is because of the rate change and how much is because of inefficiency. So we see here that the direct material rate variance is 22,200 unfavorable. That is because the prices increase for input, and the inefficiency is 66,000 unfavorable. For direct manufacturing labor variance, that is again 38,000. But that 38,000 is broken down again with respect to the rate change and with an efficiency change. This is a rate change with an efficiency change. So the direct marketing labor variance. So we see here that we are further bringing it down to, and so how do we get these figures like of 22,200 or 66,000? This is the way that we just discussed the formulas before. Actual cost incurred, how we find it out? We can get it from the budget. Actual input into actual rate. So 22,200 into 31,000. So we get it 66,200. Actual input into budgeted rate. So we see here 22,200 into 30 was the budgeted rate, and we get it this 6,600, 666,000. Flexible budget, that's a budgeted budgeted input allowed for a achieve an actual level of output and the budgeted rate. So we see here the actual input, actual input, actual rate, budgeted rate. Here, budgeted input, budgeted rate. So the difference between this and this, if you look at it, is because of the rate difference. The rate is 31, it is 32, 30. So this is one difference. Here we see that what's the difference? First thing is that we are using in actual the value we are using more and the rate we are applied. So this when we are using more input, it means it's an inefficiency. You see the input, and that's why we define it as an inefficient variance. Similarly, for direct manufacturing labor or we see here inefficiency for rate variance and inefficiency variance for direct manufacturing labor. So flexible budget and variance analysis can be applied to all level of cost hierarchies in ABC system. Focus is on flexible budget quantity calculations at the appropriate level of the cost hierarchy, such as batch level or a product sustainable, sustaining or a, so key use of variance is performance evaluation. Why we want to do variance analysis? In order to identify where the problem is and see the performance evaluation. Effectiveness, the degree to which the predetermined objective is met, that is the effectiveness, and efficiency, the amount of input used to achieve a given level of output. So where when to investigate variances for critical items, even a small variance may be investigated. We have to for a critical items. Whether the variance is small, but we have to investigate. For less critical areas, investigate only if the amount is significant or the variation is significant. Promote continuous improvement, and that helps us in improving the system. Now the level 4 analysis. Level 4 analysis is focusing on that we further break it down, this inefficiency into that we see that direct manufacturing material mix is inappropriate or a direct manufacturing material yield variance. So that is going to be further into the level 4. But here we are not discussing level 4. So this is all what we discuss. If I summarize in a way that is going to helpful to understand the whole idea. Uh, the whole idea of this chapter is to figure it out the variances. And the objective of find out the variances is that to rectify, to investigate why we are deviating. But just a variance of a bottom line, like a zero level analysis, like we are not able to achieve our net income targets or the budgeted net income is not enough. So we have to further deep it down. So in this particular topic or a chapter, we discuss uh, level up to level 3 analysis. So level 0 is only net income difference between the actual figures and the static budget or master budget net income. Then we further break it down to level 1 with the breaking down this actual figures into revenue, variable cost and fixed cost, and with the budgeted or a static budget, revenue, variable cost and fixed cost, and that type of analysis is going to give us that whether we are off because of the short of a revenue or because of the increase in the cost. Then we move on to the third level of analysis. Third level of analysis is that we have to prepare a flexible budget before analyzing that. And the flexible budget is a budget which is based on the actual activity level and the with the budgeted dollar values or with the budgeted rates or prices. Now, this flexible budget difference between the actual and the flexible budget, we get it flexible budget variance, right? And that we see that that is because of the difference in the rates and prices. On the other hand, what we did is a sales volume variance, and that sales volume variance is between the uh, flexible budget and the master budget, or static budget. So that difference is going to give us sales volume variance. That's a level 2 analysis. In the level 3 analysis, we further break it down this into the analysis up till what is the because of the change in rate, and that's what we call it as a rate variance, and what is because of the inefficiency. So in the third level analysis, what we did is we figure it out the actual input, actual rate for a material, for a labor, for factory manufacturing overhead. So actual input and actual cost. Then we compare it with the actual input budgeted cost, and we compare it with the budgeted input budgeted cost. And by this way, we figure it out the rate variance and the efficiency variance. So this is our third level analysis. And in the fourth level analysis, we further look into the efficiency into the material mix analysis or the material yield and variance or labor mix analysis or labor mix. So this is what I want to discuss from chapter number 7.